I feel good about that. I think I feel more confident now than when we were filming the last video. And to me, not a whole lot has really changed. I think the inflation has come in slightly more benign than expected, but it was sort of like we were due for that. The trend had started to inflect, and so it makes sense to me, and it also makes sense to me that the market has bounced a little bit. It really hasn't bounced all that much, but for some reason, it seems that people feel a little bit better. Sentiment has improved significantly more than the market, and I think it's just because we've stopped falling. We've stopped falling, and it feels like, yeah, we're not really rallying consistently, but the market has found its footing. There's a floor, it feels like, and I think a huge part of that also is interest rates. We've seen stocks and bonds basically behave almost with a 1-to-1 correlation. The 10-year got as high as 430 or so, and we're now below 380. So 50 basis points has come off of yields, even though the Fed has continued to tighten, and they've announced that more tightening is on the way, at a slower rate though. So I think just the whole point when we filmed the last video was that to get people to consider how much had been priced in already. Not that the news was going to get better necessarily, but that it was going to be less bad, and that the way the market works is it looks through all of that and it starts to digest things long before it's actually happened. So I feel good about that prediction, and I think it's, stocks and bonds stabilizing has helped a lot. It's interesting when you talk about interest rates with an investor or a client, because the only thing people seem to be focusing on is what the Fed is going to do. And the headlines are that the Fed is not done raising interest rates. And of course they control the Fed funds rate, and not necessarily the long end of the curve, the 10-year Treasury, the 30-year Treasury, mortgage rates even. I mean, there's obviously a correlation, but the fact that the 10-year Treasury is 50 basis points lower than the last time we spoke, and the Fed funds rate is higher, I think that is the evidence. If I needed to point to something, that's the evidence that interest rates have peaked. And I'm referring, of course, to the 10-year Treasury, the 30-year Treasury, and mortgage rates. I don't think the Fed funds rate has peaked, because there's still a high probability that they're going to raise 50 basis points in December. But again, that's the Fed funds rate, which is different than the 10-year Treasury, 30-year Treasury, and mortgage rates, which respond to the Treasury market, not the Fed funds rate. I think there's a few contributing factors. So we've had a lot of things happen in the last month. We've seen the US dollar finally start to break, meaning stop strengthening, and it's hard to say that it's weakening, but it's come off about 7 or 8% off of its high. And just bonds have found a bid. People have started to step back in and be willing to buy bonds, longer dated bonds, meaning they think that they're being rewarded for whatever risk they're taking, and they think that rates are not going to stay high forever. I think that is what it says, the fact that interest rates have started to come down, because the Fed funds rate is simply meant to control how tight or loose near-term policy is. But the long-term Treasury market is that's how investors reflect their mood for future growth and inflation. Yes, this question of the Fed pivoting is like everybody wants to know, and people are so confident on either side of the argument. People are like, oh, the Fed's going to pivot, or they already pivoted. And then there's another group that's saying that no way, the Fed is not going to pivot. They couldn't possibly talk this hawkish and then pivot. But I believe that the market is actually going to dictate when and if the Fed pivots. Have they already? No, because they're still talking about how inflation hasn't come down enough. They've acknowledged that it has started to decelerate. But for the Fed to pivot, I think everybody's got their own definition. Does that mean that they have actually stopped raising interest rates? Have they started to cut interest rates? That's certainly not happening anytime soon. But they've started to give, the language has softened, where they've said, we're not going to be raising rates forever. And they've allowed the Fed funds futures market to start to price in an end to their hikes. And I think maybe that's a pivot. I don't know. They're not going to come out and give a press conference where they say, today we are pivoting. It's going to be up to the market to decide. And perhaps the bond market really inflecting in the middle of October, meaning bonds stopped falling and started to appreciate again, and interest rates have started to fall on the long end, that may be the pivot that nobody will ever publicly reference. Yes, it is possible for stocks and bonds to move up together, and we've seen about a month of that already. And what I like, when you start to see things in the news like the failure of the 60-40 portfolio, and we started to see some articles this summer saying that the 60-40 portfolio is over, meaning 60% stocks, 40% bonds. And the reason that it had failed is because it's meant to sort of mitigate risk, but both of those asset classes fell together for the first half of the year. And once you start to see those articles, it's almost like when somebody gets on the cover of Forbes or The Economist, and it's like, okay, the story's over now. I think that was maybe a signal that both of those asset classes had fallen too far. Not that they're necessarily set to start rallying huge, but I think that's when it becomes time you can start stepping in and buying both stocks and bonds. And the short answer is yes, of course they can both rally, meaning rates can come down a little bit, bonds will stabilize and go up a little bit, and I think stocks will just sort of naturally react to that because it's just sort of represents a calming in interest rates. And it's not the all clear signal or anything like that, but I still feel confident that we've already seen a top in interest rates and a bottom in the stock market. So first of all, it's not there's not that much of an I told you so in terms of what Bitcoin actually is, because I still don't fully comprehend whether or not it needs to exist. I think the I told you so would be in the just the arrogance and the speculative froth that it sort of embodied. And it's not just cryptocurrency. There were the meme stocks and just the general sentiment in 2020 and 2021 of the retail trader, that the get rich quick idea. That's really what is, I think, falling apart. And there's, sort of conspiracy theorists that sort of believe that the Fed is actually just trying to make that go away and won't be happy until that is fully broken. So that same line of conspiracy theory thinking is that now that there's been a significant blow up in that world, perhaps the Fed can ease up. And I don't know, we'll see if there's any truth to that, but all this money that's supposedly being lost, it's hard for me to understand if it ever actually existed in the first place, because it's sort of like, hey, we've got this all these assets on our balance sheet, which really can't be quantified. There's nobody to really determine if the value is actually what we say it is, and we're going to use those assets to then borrow money in order to buy more assets, which are determined by the same sort of made-up valuation metrics. Honestly, I don't even know what to make of any of it, other than the fact that there's a bunch of money that supposedly existed a year ago, and now it doesn't exist anymore. And I don't know that anybody that's getting hurt by it, I don't know that that money or the participants in that industry are actually going to have anything to do with the real economy. That's my short answer. Is I don't know that it necessarily means anything other than the speculative fever has broken for sure, and that may actually be good news. You know, we saw on the day that the bankruptcy of FTX was announced, the market rallied. So if it's relevant, then it's relevant in a positive way for traditional assets. Generally answer what could go right from here. The market has taken a beating. I mean, we're significantly off of our highs for the S&P and the NASDAQ, and bonds got crushed this year. So what could go right? Even if we were to enter a recession, if there were signs that it was going to be more mild and that the industries being hit maybe didn't contribute as much to the real economy, that's something that could be a positive. We're assuming that we are going into a recession. But I think it still needs to be considered that we might not, or that we already did, and that we're on our way out of it. I mean, there was negative GDP growth in the first and second quarter of this year. And everybody kind of poo-pooed, you know, oh, that's not the real definition of a recession, 2 consecutive quarters of negative GDP growth.
Yeah. And jobs numbers were strong.
Right, because unemployment was never really budged. But I don't know. I mean, what could go right? We could still see a soft landing, meaning it's just a slowdown in growth, but we never actually go negative from this point forward. We could see a legitimate Fed pivot where they say inflation's broken. We're not going to necessarily ease because the economy doesn't need it, but we're going to just kind of hold things where they are and see how the economy absorbs all of this information. We could see positive movement in Russia and Ukraine. I mean, that's something that we haven't touched upon yet. I think that would give sentiment a real boost. Typically, the yield curve inverting, meaning the 2-year and the 10-year, the 2-year yield being greater than the 10-year yield indicates that a recession is looming. But I don't know if there's any data point where we've had the 2 consecutive quarters of negative GDP growth and then the yield curve inverted after that. I don't know what it indicates, and I don't think anybody else does either. So there's just been so much the last 2 years that is all these one-offs, the pandemic, the businesses being forced to shut down, a ton of fiscal stimulus, and then the Fed hiking and the supply chain disruptions, and then supply chain kind of coming back on. There's too many anomalies, I think, to confidently say what comes next. I think the thing that's working in our favor is that the market has already fallen a bunch. It's absorbed continued bad news, and it's now starting to stabilize, if not rally, in the face of bad news. So it would surprise me if we had a negative year in the stock and bond market next year, regardless of what GDP does.